Good morning and welcome to the CFRA webinar, Crypto Market Outlook in second half 2022. I'm Ken Leon. I'll be the moderator for this hour. I'm the Director of Equity Research. I want to point out a few things. So on the upper right of the screen, you can certainly send us questions in the chat box. Second, we have attachments here for both the slides themselves. So you'll have a chance to look at these after the event. And one of our presenters, David Holt, did a thematic research report on the subject. Next slide, please. So our customary disclaimer, if you can take a look, this presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. Next slide. So with me today, and I'm really excited to have these two excellent analyst presenters, John Sonsalla, he's head of strategy and senior financial services analyst at Washington Analysts, part of CFRA, and David Holt, senior equity analyst on the CFRA fundamental research team. Next slide, please. For those of you who are not familiar with CFRA, and we do like putting this timeline chart in these presentations, just to give you a sense of the breadth and scale and really our staying power in the business. CFRA is one of the world's largest independent research firms. It started as a forensic accounting organization in October 2016, acquired the S&P Equity and Fund Research. Subsequent acquisitions were the First Bridge Data, which has given us world-class data, analytics, and professionals. Then we got one of the well-noted technical research firms, Lowry Research, in 21, and most recently, Washington Analysts, which brings a very large team, institutional investor ranked in the institutional market, Washington Analysts, of which John is part of it. So today, we're able to take advantage of all these different research disciplines and leverage those for our different customer segments, but also the collaboration has really given us that secret sauce to try to not only provide in a big way insight, but also alpha performance. Next slide, please. This is called the proprietary methodology engine. It's really a flywheel, and it's really a crossroad of different energy and activity at CFRA. From a top-down, bottoms-up, top-down, we have with Sam Stolbar, Chief Investment Strategist, and sector meetings, sector analysts, able to come up with our views of the equity markets and the sectors. The analysts, the fundamental research team, which I'm a part of, do bottom-up research on industries and companies. And we do this in a way that we're leveraging not only our experience and knowledge of industries, but data and analytics. And at the very bottom here, you can see idea generation. I mentioned before thematic research. And if you're a Market Scope Advisor customer, you can see the institutional grade research that we do on thematic research. I actually just did one on video streaming. So in the middle too, as well, is the ability on Market Scope Advisor where clients model portfolios. We also have the forensic research, and a part is the very, very active program Washington Analysts has, both in publishing notes, but doing a tremendous amount of events as well. So all of this has given us a great capability, hopefully to service our clients. Next slide, please. So with that, let's get into the program. I'll go to John Sonsalla to kick it off. Good morning, John.
Good morning, Ken. Thanks for the warm introduction. Excited to be here, part of this important conversation. So let me divide my policy-focused portion of the presentation into really two parts. So, setting the stage here. I'm going to go in a bit of reverse order. So I want to remain cognizant of the topic of today's webinar, discussing key issues and catalysts in the second half of the year. But before I get there, which will be the second half of the presentation, let me first do a little table setting and discussing what I view as some of the prevailing headwinds that I do think will benefit the sector, not only in the months to come, but in the years and decades to follow. And I've set it up to play a little game here of 3 truths and a lie. I'll tell you which is which, so you don't have to worry about interpreting it for yourself. Next slide, please. So the first truth here is that regulation is decentralized. It's decentralized in terms of federal, state, and local, but there today is not one agency, not one department, not one entity that is solely responsible for regulating the digital asset ecosystem, and that the Biden administration is really taking an all of government approach here. So you can see on the slide various seals, logos, emblems of more than a dozen different departments and agencies. And I want to pick out a few, but first let me say I do think it is important to understand that, you know, for the Biden administration, I think for the federal government at large, the goal here, the end destination, is not to regulate cryptocurrency out of existence. That can't be said as being true for necessarily all sectors or industries or products, but by and large, while there are concerns related to individual consumer investors, while there are concerns related to financial stability, to systemic risks, to sanctions regimes and anti-money laundering, you know, the goal here is to figure out regulatory regimes through which digital assets can continue to exist and grow. And so pulling out just a few of these quickly, you'll see the emblems at the top are slightly larger than the rest. This is what I would consider to be the big 5. So obviously you have the Securities and Exchange Commission and the CFTC here on the top left. And then, you know, we also have the Fed, the Treasury, the OCC. These are the 5 entities that I think are going to be critical in driving a lot of the major policy decisions that are going to impact the industry over the long term. But it's not to say, you know, they're the only players in the room. You know, as we go down the list, whether you're looking at the Department of Labor and potential 401k investing in Bitcoin, whether you're talking about the FDIC and the ability of crypto banks to exist, to receive, or to become insured depository institutions, or you're looking at the Department of Energy and the Office of Science and Technology Policy, discussing miners and thinking about the energy implications. All of these entities will have a role to play in defining the future regulatory regimes of the industry. Next slide, please. So your second truth here is that legislating, like regulation, is also decentralized. There's not a single member of Congress, there's not a single committee, a party, a chamber, or even a legislative body that is solely responsible for dictating future legislation in and around the digital asset ecosystem. And what we've seen to date is that critical policymaking is really happening at all levels of government, and importantly, it is happening across partisan lines. I'll talk a little bit of that when I get to the right-hand side of the slide, but it's important to note up front that cryptocurrency legislation regulation, it is not inherently a partisan political topic in the way that I would say 90% plus of issues in Washington are. So first, looking at the left-hand side of the screen, you know, the first bills referencing cryptocurrency were only introduced back in 2013, 2014, and we've really seen a tremendous amount of growth of lawmakers introducing proposals to provide additional clarity to the industry. These bills range everything from stablecoin regulation to the definition of a security versus a commodity, sanctions regimes and compliance, tax reporting, broker definitions. So they cover a range of topics. But you can see just in the last 10 years, we've gone from, you know, 1 bill to, you know, today upwards of 80 bills. And I wouldn't be surprised if before the end of this Congress, 2021, 2022, that we scratch the, you know, 100 bills introduced marked. And then on the right-hand side of the screen, again, this is just further proof that when we look at state legislation that references cryptocurrency, digital assets, blockchain related terminology, you can see there's a pretty even split between bills introduced by Republicans and Democrats. There's a lot of cross-pollination efforts, bills that are maybe introduced by one party but supported by the others. And that's important and will matter as much as we tend to focus on the regulators. There's a lot happening legislatively, and that activity is only set to increase. And if we can go to the next slide, maybe this is an indicator of why we've seen so much legislative activity. But your third truth here is that lobbying is also decentralized. I'll caveat it with the fact that it's often coordinated as well, which is important. But when we think about lobbying, again, there's not one trade association here that is really driving the advocacy efforts, the political efforts in and around digital asset regulation. If we look at the left-hand side of the screen here, you'll see a marker for Coin Center. Coin Center was the first entity to register federal lobbyists to work on digital asset related issues. That was back in 2014. And then in less than a decade, if we're looking at the middle of the slide now, where we are today, these are all entities that today are registered and reported as actively engaged in federal discussions with policymakers on digital assets. And this is really just a sampling. I couldn't fit, if I wanted to, every entity, every company, every trade association who's working on these issues today on a single slide. But if you look at the top in the darkest blue, these are 4 trade associations all stood up in the last decade that represent collectively the industry and are working on various policy initiatives. Below them, when we think about the exchanges, Coinbase, FTX, Kraken, Robinhood, they all have their own lobbying apparatuses and operations actively working in Washington. We see coin issuers like Ripple and Stellar having registered lobbyists, as well as stablecoin issuers, the biggest, Tether, Circle, Paxos. And then at the bottom in the lightest gray, you can see that miners have also increasingly started to engage in Washington, especially as they've seen some activities occurring at the state level start to come to the federal level, thinking specifically about New York working to ban Bitcoin mining that relies on carbon-intensive energy sources. So lobbying has dramatically increased. It's going to continue to do so. And then on the right-hand side of the screen here, I think this is perhaps most interesting. This is not a look at lobbying dollars, the amount of money spent on lobbying, but it's a look at political contributions by employees and PACs of various organizations. And this election cycle, 2021-2022, FTX is the second largest contributor to federal candidates, parties, PACs, and other political organizations. They've spent more politically. They've spent about 2x times Oracle. They've spent 4x times SEIU, which is a major labor organization, and they've spent nearly 10 times that of Google. So you can certainly see that they're very active in lobbying, but they're also very active politically, and that matters over the long term. Next slide, please. So here I promised 3 truths and a lie. Your lie here is that existing rules need not apply. We scratched out not here because existing rules do apply here. And I think this is a critical understanding that a lot of stakeholders in the industry need to come to grips with, is that digital assets and stakeholders, there's some expectation, they believe, that the regulatory perimeter, existing laws and rules, that they need to be revised, that they need to be flexible in order to fit a lot of the unique nature innovation happening within the sector. But a lot of regulators take the opposite view. They say we have existing rules of the road, and that if you're going to operate within this sector, that you need to comply with those existing rules. When we look at the left-hand side of the slide here, so this is just 5 laws that have all been used to bring enforcement actions against various stakeholders within the crypto industry. You have the securities laws that are dating back to the 1930s and around the Great Depression. You have the Commodities Exchange Act, the Bank Secrecy Act, which really relates to anti-money laundering issues. And then at the bottom there, this is really sanctions law. And on the right-hand side of the screen here, you can see a statement by Chairman Gary Gensler, and he has said this repeatedly over the last several months, that his view is most tokens today are securities under the jurisdiction of the SEC, unregistered securities is that, and has repeatedly called for crypto exchanges to come in and register as national securities and exchanges. And these comments are important, and we'll talk a little bit about some of the near-term issues we see related to tokens and exchanges. And then below that flagging, this is what Treasury Secretary Janet Yellen has said as recent as this year, raising concerns about tax evasion, illicit finance, national security issues. And again, both of these key regulators reiterating their view that the industry at large needs to come into compliance with existing laws and regulations. Again, it's not to say Congress can't intervene here, regulators can't change the rules, but for the time being, they need to comply with the rules of the road as they exist today. Next slide, please. So now let me pivot. I've talked about some of those table setting items. Let me talk a little bit more about what we see in the next few months here through the end of the year. And I think first, it's important to realize that in our view, the crypto winter has brought with it some regulatory heat that we view the market volatility, whether you're talking about the collapse of Terra Luna, whether you're talking about Celsius, that these events have increased the likelihood and potential scope of an aggressive regulatory response. And part of the reason why our view is as such is when you look at the left-hand side of the screen here, for regulators, for policymakers that had concerns with the industry, maybe they were skeptics, maybe they were outright critics, the recent market volatility has given them some proof points, or at least tangible examples to point to individual investors, consumers, constituents, however you want to define them, that were directly harmed as a result of some of these recent market events. And they're going to point to those events as justification for actions that they're taking. On the right-hand side of the screen here, it's important to note that the SEC recently doubled the size of its crypto assets and cyber unit, which sits within its enforcement division. And they directly outline, here are 6 different parts of the crypto ecosystem that we are going to be looking at for more enforcement activity in the months and years to come. And so it's everything from token offerings to exchanges, lending and staking products, DeFi platforms, NFTs, kind of an emerging front for regulators, as well as stablecoin issuers. Next slide, please. So the remaining slides, I'm going to talk about some things to watch here as we come through the remainder of the year. First, watch the administration. I know that's a broad statement, but from if we go back to the first slide that I showed, there are a lot of cooks in the kitchen here. And one of the things that all these cooks are going to be producing is various reports, recommendations, frameworks that they were mandated to produce as a result of an executive order President Biden issued on digital assets back in March of this year. The meat and potatoes of a lot of these reports are due in September, so we're only about a month away from probably seeing ink on paper here, but they cover a broad spectrum of issues. The Treasury is going to produce a report with a lot of focus on central bank digital currency. They're also going to be looking at financial and payment systems implications for digital asset adoption. Moving down to the middle, the Department of Justice is actively reviewing issues related to criminal activity in digital assets. The fourth, we intimated this at the front end, but the Office of Science and Technology Policy is looking at the climate change, grid implications, energy transitions issues related to blockchain technology. Again, this is an issue that we've seen take off at the state level, but is certainly gaining more traction here in Washington. And then last is just the Department of Commerce report on U.S. economic competitiveness relative to digital asset technology. So watch for these reports. I don't want to overstate their importance, but they will provide strong table setting and might give some inclination of where various regulators are going to go, whether on their enforcement agenda, whether on their rulemaking agenda, and also highlight some areas where regulators might think that they need additional authorities and responsibilities in order to have effective oversight of the industry. Next slide, please. So the SEC has been and will continue to be, I would say, the #1 agency to watch for stakeholders within the industry. We do expect the SEC to continue to ramp up enforcement through the second half of the year and could target an exchange in what would be a very closely watched action. When you look at the top left part of the screen here, these are 10 tokens. There's XRP, which was issued by Ripple, along with 9 others. And pairing this with the right-hand side of the screen, those 9 tokens in red were all part of a recent action that the SEC took against a former Coinbase employee, where they essentially alleged that the employee was letting a relative and friends know when Coinbase was going to list these tokens on its platform or make the announcement for the listing, and then allowing those individuals to more or less front run the announcement. And parsing this out a little bit, there was a parallel action. The Department of Justice took action against the same former Coinbase employee and those in his network who were involved here. But they did not allege insider trading, but that's exactly what the SEC did here. And the SEC in its complaint, if you look at it, methodically walks through why it believes all 9 of these tokens were unregistered offerings of securities. And it's important because the 7 in darkest red actively trade today on Coinbase's platform. You can see Binance is also outlined here in red. AMP did trade on the Binance platform, but has since been removed. And if we can go to the next slide, kind of pairs with this one, a lot of this is going to come down to not only what the SEC believes, but what the courts believe to be true and what their interpretation of the law is. And so a reminder, when the SEC sued Ripple in December 2020, looking at the right-hand side of the screen, for an unregistered securities offering, Coinbase took action within 2 weeks to announce that it was going to delist XRP from its platform. It has not taken the same steps as it relates to 7 of the 9 tokens at issue in the more recent filing against a former Coinbase employee. But the courts will play a role here in interpreting what's known as the Howey test. So at the bottom part of the screen here, you can see the Howey test. It's born out of Supreme Court litigation that dates back decades, but it says a security or an investment contract is an investment of money in a common enterprise with a reasonable expectation of profits derived from the efforts of others. And you really have the SEC and some of the exchanges here coming to a different conclusion about which tokens, what tokens, if any, do qualify as unregistered securities offerings. But our view has been and continues to be that it is difficult for the SEC to come out and say certain tokens are securities, and while those continue to trade on platforms like Coinbase, having those 2 things exist in perpetuity just does not seem likely. So certainly a higher risk of an enforcement action against an exchange. Next slide, please. And so continuing with the courts, we would say that while the SEC has taken action against certain industry stakeholders, it is also the subject of litigation itself. And so the SEC back in late June denied an application by Grayscale to launch a spot Bitcoin ETF, essentially converting its existing Grayscale Bitcoin Trust into a spot Bitcoin ETF. It also denied a similar application from Bitwise. And Grayscale had been out in the media and said that if it had an adverse action from the SEC, that it would sue the SEC, and that's exactly what he did, filing suit literally on the same evening, or at least announcing a suit on the same evening of the SEC's decision. And Grayscale here is essentially arguing that the SEC's decision was arbitrary and capricious, that we already have futures-based ETFs for Bitcoin, and that there's no strong rationale for denying their conversion to a spot Bitcoin ETF. This is not to say that this litigation will be resolved this year. There will be some activity through the remainder of 2022. But overall, in the long term, we do think that odds favor a spot Bitcoin ETF eventually being approved in the United States. And that's important for Grayscale, given that their current GBTC trades at a really significant discount to its NAV. Next slide, please. So I want to make sure we have time to get to David, so I'll speed through here. But when we talk about Congress and what to expect through the rest of the year, I think stablecoin legislation should be at the top of everyone's list. We do not think that it will ultimately be enacted into law this year, but we think next year odds are favorable that we have stablecoin legislation signed by the president, creating a new regulatory regime around fiat-backed stablecoins and around stablecoin issuers. We've seen positive momentum from both Congress, but also the administration moving off a position they previously had that issuers should be insured depository institutions. Now they seem to be coming into alignment with Congress and having more flexibility about the chartering options and the types of issuers that can issue stablecoins. On the right-hand side of the screen here, there will certainly be winners and losers here. We think Paxos, which issues Pax Dollar and Binance USD, and Circle, which issues USDC, are well positioned to comply with this new regulatory framework, which will govern reserves, auditing, disclosures, and so forth. But continue to watch Congress here, and certainly Maxine Waters, who's the chair of the Financial Services Committee, and Ranking Member Patrick McHenry. They're working together in a bipartisan fashion, and we expect legislation to make it across the finish line next year. Next slide, please. So this is the last slide. I think what I wanted to leave you all here, at least with a policy perspective, is that there are a lot of skirmishes and battles ongoing, but this is a much longer war. I was speaking with somebody in the industry yesterday who said we're not in the first inning of this, we're in inning 0, and that a lot of these discussions are going to take time to ripen and to resolve. But also, what I would say here is that the piecemeal approach, the trees within the forest are important. Like I said, I think we can get clarity around stablecoins, some tax reporting issues, maybe the broker definition, while other issues like a central bank digital currency will have a longer tail. And lastly, just remember that as much as we talk about the digital asset industry and ecosystem, there really are some seismic impacts that this could have for a lot of traditional financial market players, whether banks, card networks, exchanges. And so watch not only the industry, but again, the implications of the industry on the broader financial services ecosystem over the long term. And with that, let me hand it over to my colleague, David Holt.
All right, thanks, John, and truly a pleasure to be here. So excited to dig into the latest around crypto markets. It's definitely been interesting times with all the notable events and market cross currents that have hit the tape so far in 2022. So I'm really going to try to do my best to provide what we believe are the hardest hitting proof points to help you as an investor really navigate through all the noise and what to monitor heading into the second half of the year. So if you flip to slide 19, you'll see what we plan to cover today. We've broken out the topics into 5 broad buckets that we think could actually drive the narrative, with the first being the macro overlay, which we think will be important to establishing the future direction of more speculative assets. The Ethereum Merge, which is slated for completion by mid-September, Bitcoin mining, which have some overlapping risk associated with how well the merge actually does, and how you as an investor should really manage risk in current market conditions, especially with some of the more notable names, as John alluded to, being caught in regulatory crosshairs more recently. So finally, we'll round it out with more nascent trends that have been popping up to help keep you informed in areas to really monitor going forward. So scooting over to slide 21 with recent price action. So the old adage of prices taking an escalator up but an elevator down does hold true with many different market cycles, and cryptos it's really been no different. So similar to how I break news to loved ones, do you want the good news or bad news first is really how it usually goes. To us, the good news is you've bounced off the key support levels at 20,000 for Bitcoin, and you've rallied from there. That we actually highlight in the 6th call out on the right hand side of that chart. Another important item though is recent price action also keeps the average drawdown with past crypto winter cycles that we've experienced so far. There's been 4 of them that we've also circled in red. So on to the bad news is we don't really believe you're fully out of the woods yet. You still have a few trees to dodge. Going forward, I think you'll definitely see a few swing factors that really need to fall into place to keep sentiment on the right side of the boat going forward, which actually makes a pretty good segue to slide 22. So being fully aware that the past is really not always a prologue of what the future holds. It could be an equalizer throughout the back half of 22 and 2023. So we would actually flag that there's 2 big driving forces that were not present in the past drawdowns. A being the macro overlay that we've already spoken to, and B, the tangible activity on the regulatory front, which to us are again, something to call out that we highlight in step 1. So moving clockwise with the upside scenario in the second call out, you get a continuation of better than feared CPI readings, which means economic activity is, shows some adequate declines here, allows the Federal Reserve to fully pivot to make a dovish stance in 2023 with expectations of maybe further relaxing rate hikes going forward. So for the range bound scenario, you're able to kind of keep skeptics at bay. You have enough clarity around some of the market drivers to really keep crypto prices treading water and really hugging a flat line. So that actually leads us to the downside scenario though. The real question that I think we need to answer is how far offsides are we currently, if at all? So do technicals really tell us we revisit lows from June? Probably not. Have we reached peak inflation? Yes, probably, which kind of helps take a 1970s Volcker scenario off the table, but it really doesn't mean the job's actually finished to fully tame inflation and the rate hike cycle is actually over. So we would actually argue that, the 40% rally off the lows is exactly what the Federal Reserve doesn't want to see, and it could imply risk-sensitive assets could see, further digestion of gains, especially since those speculative assets, that were so drastically underweight aren't so anymore after the recent run-up in price. So moving to slide 23, and bottom line, the individual crypto exposure per investor slides up or down depending on the individual's risk tolerance. So everyone's going to be different. There's no magical recipe for success. Here we've actually provided a risk curve with arrows pointing to an increase in the risk-free rate or 10-year treasury that illustrates what the Federal Reserve is trying to accomplish by actually taming inflation and making money more expensive. So this in turn kind of hurts assets that they're further out on the risk curve, like cryptos or VC venture capital, who have overly benefited from excess liquidity being injected into the system. So to put this in perspective of how out of hands things got, exit multiples for startups nearly tripled during that time frame, from 6 times to 15 times sales. You had some of your biggest VC firms, a la SoftBank, actually putting over $2 billion of capital to work every single month, which obviously is not sustainable. You kind of put this all together, we still think there's ways to capture alpha, but actually limit downside risk with placing the riskier bets like cryptos in kind of a satellite position, further out in the risk curve, as we picture in the slide. This way, it one, helps capture some asymmetric upside if things turn for the better, but two, can actually manage risk while your core positions or on the lower part of the curve do more of the heavy lifting and kind of shadow averages. So on to slide 24, and this is kind of what happens when you don't focus on an approach more so anchored towards risk management, with a quick breakdown of different kinds of stablecoins. So the big call out here is A, they're not created equal, and B, there's a stark difference between a fiat-backed stablecoin, which is directly pegged to a tangible currency, which kind of helps live up to the name. And then two, when you look at an algorithmic stablecoin, it's not collateralized by any asset. So in conjunction, when you move to slide 25, I'm going to quickly walk through why algo stablecoins are catching so much flack currently. And that's obviously with the poster child Terra Luna and how many people lost money so quickly from this. So from the left to right, we'll unpack it. Firstly, individuals were attracted to a large 20% fixed yield, which is unrealistic. You had one token, Terra, which was tasked to kind of keep that one-to-one equilibrium. But then you had that second token with Luna, which was automatically printed to absorb volatility. So the biggest issue there was no withdrawal restrictions. So as big selling kind of picked up steam, it broke the peg and it kept this feedback loop open. So more Luna was printed, it caused hyperinflationary conditions and wiped out over $40 billion in capital. So events like this really do have a cascading effect though, just given the fact that liquidity to meet the withdrawal request were actually tied up in other currencies like Ether. So moving to slide 27, we'll get into some of the good stuff with the upcoming catalyst with Ethereum Merge, which is obviously dominated headlines. I'm sure a lot of you have already seen it across different news flows, but what exactly is it and why is it important? So spanning to the far left diagram, you have what most layer one networks like Bitcoin or Ethereum currently use, referred to as a proof of work protocol, and why miners use power intensive rigs to actually solve complex equations to verify a transaction, place a block on a chain, and collect a reward from it. So moving to the middle diagram, you have a proof of stake, which is what Ethereum will actually be moving to. It's a similar process, but miners are forgers in this case. They stake coins for an opportunity to validate a transaction and actually win that reward. So once you're validated, though, you're actually put into a lottery process with an opportunity to earn that reward by placing a block on the chain itself. So when you hear staking, this is what people are actually referring to. So lastly, a few quick housekeeping items that we list on the right-hand side of the diagram, the do's and don'ts of the merge. So the first thing we would stress, the merge will not actually reduce transaction costs, or what's referred to as gas fees, or actually allow you to withdraw staked Ether, which is very, very important and likely comes up in future discussions and maybe even later in the presentation. So what the merge will do is actually reduce the supply of Ethereum tokens drastically through what's referred to as halving events. So that's where the availability is actually, or supply of ETH is cut in half 3 times. So if you have, or you're a believer in supply and demand, this is a pretty likely culprit to why Ethereum has outperformed more recently. So another large advantage to the transition, last but not least, would be drastically shifting the stance from the emission standpoint. And it generates 0 emissions during the 9-month lockup, and roughly about 90 to 95% lower than a proof of work standard after that, as intensive rigs will not be no longer used in some cases. Slide 28, please. So here we list a roadmap for the Ethereum Merge and key milestones of when everything happens. So the big point we would call out is Beacon Chain, which is the proof of stake version of Ethereum that's actually been in testing since 2018, but launched in late 2020. So from here, there's actually going to be 3 different phases of hard forks, which is basically a step change in protocol. One that occurs in the first week of September of this year, so the second tranche in mid-September, and then the grand finale, which is referred to as the Paris hard fork shortly after. So what's really fascinating to me, it's also really critical to remember, is all these developers want to do this seamlessly with no downtime. So I like to kind of think of it as like your uncle that's at a party that does tricks around the holidays and tries to pull the tablecloth from the table, but keep all the plates and glasses in their original spot. It's obviously high risk, but impressive that they pull it off. This is kind of the same concept. So said differently, this is also incredibly tough in the fact that we would flag that it's not only a preview of things to come, but we actually call this out in the bottom row titled "What Happens Next." You already have new add-ons in the works that probably solve other shortfalls of Ethereum still to come after the initial merge occurs. So slide 29, please. So here we highlight some of the risks to watch and what we can really quickly cycle through, but macro factors we already went over. Second risk would be the merge date gets pushed out, which we're incrementally more confident this will not be an issue with some of the updates we've seen. And then 3, the further crypto contagion. Maybe you get ripple effects from other credit-related events like Celsius, which could have adverse effects on Ethereum because some of those troubled platforms had stakes in other cryptos as collateral, which is always a risk in the space, given that the fact that you have so many bad actors that you really haven't identified yet. So now that brings us to slide 31. Here from left to right, we've really mapped out the business model for Bitcoin mining mechanics through a proof of work method and really how miners actually generate revenue. So The key takeaways here is the industry is one that could, and I emphasize could here, see some of the biggest changes from the merge, given some of the potential outcomes that could make this line of work more obsolete, which we've already discussed. So I'm not going to go through the intricate details here, but you can see the concepts when you move from left to right. And then when you move to slide 32, it's the biggest knock against this line of work is the large energy draw that's necessary to power the rigs that solve the complex equations. So since covering this topic, I've seen copious amounts of data that really support both sides of the argument. I would say one of the most eye-catching for the opposition is Bitcoin mining draws enough energy consumption to run every TV in America for over a year. However, when you kind of zoom out and look at it on a relative basis, the other party also makes a pretty good argument. The data points listed here on the slide were actually taken from a Bitcoin mining consortium, but really the gist of the argument is most advanced mining rigs, like the Antminer S19, it's really made large efficiency improvements. So you can kind of see that in the bottom chart on the right. And then also when you kind of zoom out and look at the per industry or per country perspective, it's a pretty small amount, which we call out in the upper right bar chart. So then when you factor in halving and more efficient hardware going forward, that number probably has some leeway to still get smaller. So pivoting to slide 33 with mining rig economics, they've been under big stress recently as they've really been hit by the 1-2 punch of tensions with Russia and Ukraine. It really pushed down energy prices, pushed up energy prices and the crypto price decline, which has really compressed margins and made mining farms actually shutter rigs and shut down operations. So we would note this probably does have direct implications to the crypto markets themselves, as it reduces hash power, which is considered the raw computing power of each individual network, and probably puts downward pressure on prices as some of these companies liquidate positions to right-size their balance sheets. All right, onto the fun stuff now. I'm on slide 35. So here we'll quickly cycle through some key markets and sizing in the market. So last time I checked, there was a big amount of different cryptocurrencies with over 15,000 in existence, and yet a market cap of over 1.4 to 1.5 trillion. So I included only the larger ones here, which many are linked to the networks listed below in the third box, broken out between layer 1 and layer 2 networks. Just for a quick refresher, a layer 1 refers to a blockchain, like a blockchain network like a Bitcoin or Ethereum, while the layer 2 is more so a third-party integration that can actually be used in conjunction with the layer 1 networks. So other notable callouts would be the facilitators that we've titled, who have really made a push into cryptos in some way, shape, or form. I do cover a lot of these, but for context, I put them in a scatter plot on the right-hand side based off of beta or market risk and overall size. So this is just to kind of conceptualize where they sit on the risk curve, but no surprise on the upper left, you have companies that live or die by crypto prices and maybe potential catalysts, all the way to the upper left-hand side of the chart. And then on the lower right, you have exposure to some other companies that have companies or cryptos that are growing exposure, but not the main driver of the business right now. So the key takeaway here is investors should really pick accordingly based on their risk appetite and their overall size. So now I'm on slide 36. Here we're really just trying to show investors that some, but not all investment factors of some that can actually help you choose securities. So we've kind of merged a portfolio manager, a top-down approach, and an analyst approach, bottom-up here. I would point out, if you cycle through this section, we've actually walked through most of these investment factors in some way, shape, or form. So for example, key factors from a bottom-up approach should be, first assessing a risk appetite, what type of vehicle you want, whether it be kind of a pure play currency or a layer 1 network, and then really assessing it from a current risk to reward trade-off. So where are fundamentals versus expectations, which is a perfect segue to slide 37. So if you corral all the prior slides together, this is our attempt at kind of putting everything in motion here. So going from left to right, we can use our recent downgrade of Coinbase as an example here. So first, you look at the macro overlay, it's still at risk, which we've detailed. Crypto pricing, it's still depressed, but actually building a base, which is positive. But moving to risk controls, as John highlighted and alluded to, the regulatory environment, the push-pull there, it still remains a risk. So competition, it's also a growing risk with recent acquisitions from the likes of FTX and the founder, Sam Bankman-Fried, who, he's rolled up a lot of companies to directly compete with Coinbase. And then finally, fundamentals. So you move to that third block there, and you have monthly transaction users probably see a wide range for 2022 and maybe 23, but volume still fall in 2022 itself. Balance sheet's well capitalized, but it actually burned over $420 million in cash in 2Q22. So in our view, given shares actually doubled off of pretty oversold conditions over the past few weeks, we concluded it tipped the risk to reward out of favor. And it actually resulted in our recent downgrade, given Coin's future itself still needs a material rise in crypto prices and some of these other future catalysts that I think maybe some investors could be getting overly excited for, like the ETH Merge, but haven't really been tangible or materialized yet. So now moving to slide 38, we have our current recommendations for names that are in some way involved with cryptos, but again, with different risk profiles, which is the common theme for this section of the presentation. So for the most part, we really wanted to make this available for you to really sift through the recommendations and theses at your own accord. But again, just try to heed from that advice of managing risk carefully with a focus, at least for us, which is on a durable business model, a cash generative business, high returns on capital, and something that actually you can hang your hat on to kind of navigate through current choppy market conditions. So rounding it out with the last slide here with closing thoughts on slide 39. I know we're a little short on time here, but I'll quickly cycle through some events that we think investors should watch going forward. One is institutional lending using blockchains or layer 1 networks. You've seen early success with companies like Maple Finance and lending pools themselves, but going forward, I think compliance guardrails will definitely be needed and be an X factor going forward. But another would be multi-chain networks that really allow you to fuse blockchains together. And lastly, I would say Web3 that intersects with social media and eventually might supersede social media or the need for both platforms. So I know, this is somewhat far-fetched, but not really completely unrealistic, assuming adoption for Web3 and cryptos continues to pick up steam. So with that, I really do hope it was helpful, and I'll pass it back to Ken to see if we have any Q&A.
Thanks, David, and just great comprehensive insights into these subjects. I want to go quickly to Q&A, and John, first question is, beyond stablecoin legislation, do you think Congress will provide any clarity on whether certain digital assets are a security or a commodity?
Yeah, so I guess the short answer is this year, no. Though we could see some positive momentum. So there are really two bills, or there are two bills out there right now in Congress that would try to alter the definition of what is a security or a commodity, or at least provide more clarity to the industry. So there's a bill by Senators Loomis and Gillibrand that would define the term digital asset, as well as include terminology for an ancillary asset, with the idea that you're creating a new definition that puts some cryptocurrencies, I'll say, outside of the guise of being a security. I'm not expecting much activity on that bill this year, though it'll certainly be a marker heading into next year. Where we could see some action is in the Senate Agriculture Committee, where the chair and ranking member have introduced the Digital Commodities Consumer Protection Act. And so that creates the definition of a digital commodity, explicitly says Bitcoin and Ether are not securities, excluding them from the definition. And that could get a markup as soon as September. But what I'll say, well, I think both of these bills are helpful, and it would be good to get some definitional clarity around what's a security versus what's a commodity. Neither of those bills actually alter the definition of a security. They create some new definitions, but it's not to say that they upend the existing Howey test. So I think there will continue to be risk related to certain tokens and their issuances being classified as unregistered offerings of securities. And again, as I pointed out, while Congress can provide some clarity, I think the courts will also play a major role here with the ongoing Ripple litigation and potentially future cases.
Yeah, so the digital assets are interesting, or perhaps digital currencies. And, over to the Fed, they did provide some guidance, and there's dialogue with banks. And what do you think? Is this something with just a tremendously long timeline where there's notice of inquiry, proposed rulemaking, or something that would be relevant in an investor time horizon?
Yeah, well, I think in the near term, the concern has been and will continue to be, and this applies more broadly than the Fed, but around enforcement activity, less rulemaking activity. There are actually entities like Coinbase who have called for more rulemaking to provide clarity to the industry, as opposed to just what we call regulation via enforcement, which rules take a lot of time and can be subject to legal challenges. Enforcement activities that drive policy tend to be quicker. This week, as it relates to the Fed, was a bit of a mixed bag. On Monday, they came out, they issued some final guidance, creating tiered guidelines for novel banking chartered entities to gain access to Federal Reserve accounts, also known as master accounts. And some viewed that as a positive. There was only one reference actually to the term cryptocurrency, but it was seen as opening a door. It was the third tier, so it would require the most kind of aggressive due diligence, but potentially opening the door to Fed master accounts for some crypto banks, some that we've seen chartered out in Wyoming under some unique conditions. But then on Tuesday, they came out and kind of reminded, similar to what the OCC has already done, to say if you are a supervised bank by the Fed and you're engaged in activities related to digital assets, you better be sure you're kind of within the regulatory perimeter, that you're complying with the law, and that you need to notify the Fed of these activities if you're engaging in them or you plan to engage in them. So it was a bit of a mixed bag. I'm hopeful that we could get more guidance from the Fed, the OCC, and other regulators, but I think that's more of a next year and beyond conversation than necessarily getting clarity for the banking sector this year.
Great. David, you really flagged the Ethereum merge, and I wonder if you could shed a little bit more light on the investor implications, and then also, since you do cover Coinbase, if there's any implications over on that one.
Yeah, sure, great question. Let me think about how to conceptualize that. So in regards to the first part, there's definitely some developer call transcripts that are floating around of how that merge itself is progressing. So again, we don't question if the merge gets done, but because the switch in protocol is daunting enough as is, many stages are still to come behind it. So you have lower transaction or gas fees, which I mentioned. It's not going to happen this go around, but does in the future. It probably increases usability and it compresses costs going forward. But another one is actually being able to withdraw ETH. So right now you need to put 32 ETH on to validate a block, and those two are probably add-ons that need to happen in the future for the second part of your question, which is around Coinbase. So I would really say longer term, Ethereum itself could be a revenue catalyst for Coinbase, especially if it really does spark more institutional adoption. That's just as clients can stake more ETH for yield, which actually is expected to rise from 4.5% to about 7%. But it's with this serious caveat, because I think it's a common misconception right now that Coin has actually rolled out a liquid staking ETH option, which it hasn't, because one, the merge itself hasn't happened, and then two, when you dovetail back to your first part of the question, until that add-on goes live, which could be months, could be years, you can't actually withdraw staked ETH assets right now. So I think this is it was actually covered in the most recent conference call, but CFO Haas actually indirectly went into the notion that for a lot of investors, especially on the institutional side of the house, it's really unacceptable to have a current structure right now of being invested and having capital invested without knowing when and where you can actually pull it back out. So that's
Great.
That's a clarification.
John, how much of a priority is digital assets and even crypto-related activities? And I'll just stack them with U.S. Treasury, SEC, and where I'm going with this, John, is it one where it's important because of the trends, the magnitude of the trends are becoming more significant, or is it having to do with the players and maybe players change, whether it's Janet Yellen or Gary Gensler? Can you kind of navigate us through that in terms of where we could see policy on these areas?
Yeah, well, I think some of the priorities are dictated naturally by individuals in charge of various departments and regulators. You know, a change in administration in 2024, you could get a different, tone and potentially regulators who are, more interested in aiding the industry or providing flexibility in, the regulatory regime. But I mean, I would have to say that digital assets are high on the priority list of just about every regulator, at least the big five that I noted in my first screen. It's not to say the SEC is also looking at ESG and climate reporting. They're looking at equity market structure reform. There's a lot on their plate, but by and large, for whether it's the SEC, certainly the CFTC, Treasury, even the Fed, if we look at the latest Fed minutes, we can see that a conversation about digital assets, stablecoins, was part of what the Fed board was discussing. So certainly high on everyone's radar. Again, I think the challenge, unfortunately, in the near term is that you're more likely to see from the enforcement side activity by regulators, less actual rulemaking. For the SEC, that's exchanges and tokens. For Treasury, it's a lot of sanctions. Very, I think everyone should be on high alert about potential actions related to sanctions, and we saw some of that related to Tornado Cash just recently. And so it will depend on kind of the entity and what's within their jurisdiction, but at least through the remainder of the year, expecting more enforcement, hopefully some guidance, and with rulemakings to come with a longer tail.
Great. So John, I'm a bank analyst, and there's plenty of regulation, both U.S. and outside the U.S. And when you think of the G12 countries and these topics we've presented today, is there the beginning of dialogue, and is there a developed country where they're more advanced or further along in terms of policy making on digital assets or crypto?
Well, I would be hard pressed to note a specific country, but I will say, I mean, these conversations, as much as we say they're federal, state, and local, they're certainly international. Treasury is engaged in ongoing dialogue with its counterparties, as is the Fed, and specifically talking about the banking sector. I mean, I think what's going to happen in and around stable coins will be very important to the banking sector. But over the long run, the potential for a U.S. central bank digital currency could have just sweeping implications on the financial sector. I think a lot of those are already being brought to the forefront, and kind of a notion that if we do have a central bank digital currency, a U.S. digital dollar, that it needs to be within an intermediated system where it's really banks utilizing a central bank digital currency, as opposed to what we might see in China, with individuals actually receiving benefits through a U.S. digital dollar. So the conversations definitely are international, but again, it's interesting to me that if we take this in another direction, there are a lot of U.S. allies and peers, whether you're looking at Canada or Europe or Australia, where they have a spot Bitcoin ETF today. and it's one we don't have in the US, and there's going to be litigation. There is litigation over whether or not one should be approved by the SEC. But so, while the conversations are ongoing, it's not to say that everyone is necessarily on the same page as to the destination.
Great. David, last question for you and for everyone. Again, we have made available the slides and David's thematic on subject, but one slide 38 has your recommendations, and we didn't speak much, but when you have names like Visa, MasterCard, or we're talking about payment processors, is there also larger opportunities here with blockchain technology?
As of right now, I would say yes, because you're constantly trying to be cognizant of what's happening with private markets and what implications that can have on some of your more traditional payment networks like a Visa or MasterCard. But with what you've seen in private markets, the drawdowns, the down rounds, I think it's really reset that process itself. And when you see some of the investments on the traditional side with a Visa, a MasterCard, or even a PayPal, which I would pull into the mix, which you actually upgraded after first quarter results, you had headwinds that turned into tailwinds, which I think people were overlooking. Lap tough comps regarding the eBay disengagement, and you had a reserve release from the pandemic. It really made the risk reward more favorable, just because when you kind of zoom out, if you're really a maximalist and you kind of see this as kind of an ongoing trend, does this disrupt the industry itself? I don't have a crystal ball, and if I could see in the future, I'd be a much better analyst. But as of right now, when I'm looking at fundamentals and I'm looking at the market backdrop, and I kind of walk through my whole process, and what I showed you with the fundamental walkthrough, that I'm looking for durable business models. I'm looking for predictable cash flows and companies that might have some inroads to cryptos or blockchain networks. But also, it's probably not the key driver of the fundamentals right now. So to answer your question, yes, there are ways to gain exposure, but also being able to kind of, risk control on the other end of it too, which I think is a very important aspect.
Great. If we can go to the next slide, Dawn. So I certainly want to thank John and David for putting the time into this presentation and giving great insights in an area that is top of mind for many, whether it's investors or policymakers. Quickly here, since we're past the hour, to get more in research insights, you can visit us either at MarketScope Advisor or for Washington Analysis for their in-depth views in terms of policy and regulation. And certainly we'll be doing more webinars in the future. Thank you for your valuable time and enjoy the rest of your day. Take care.